All right, welcome to this high-energy, exam-oriented revision explainer. I am absolutely thrilled to be your guide today as we master every single provision, form, and timeline in the registration of charges for your CA exams. We're going to take this chapter and completely transform it from a confusing maze of compliance into crystal clear logic. My goal today isn't just to help you pass, it's to give you that all-India rank level of conceptual clarity. We'll be dissecting the legal compliance engine, uncovering the examiner's absolute favorite traps, and building some unshakable memory techniques along the way. So let's get into it.
Okay, let's just dive right into the logical life cycle of a charge. Today we're going to cover the basics of corporate charges, registration and modifications, satisfaction and registers, defaults, penalties, and rectification, and then we'll wrap the whole thing up with a final mega exam revision. Kicking things off with Section 1, the basics of corporate charges.
So what exactly is a charge? According to Section 216, a charge is an interest or lien created on the property or assets of a company as security for the repayment of a loan, and it explicitly includes a mortgage. Think of it this way. A really practical business example is your company taking a massive loan from the State Bank of India. Now, the bank isn't just going to hand over the cash on goodwill alone. They need security, right? So you offer your manufacturing plant as that security. The literal moment you do that, boom, you've created a charge on your property. For the exams, I need you to mark this as a fundamental one-star concept. You absolutely must know this baseline definition inside out before we move forward. Now for the ultimate showdown, and pay attention because the examiner absolutely loves asking questions from this area. It's a high-probability 3-star topic: fixed versus floating charges. A fixed charge is created on specific, identifiable assets. We're talking about your land, your building, specific factory machinery. You literally cannot sell these without the charge holder's direct approval. On the flip side, a floating charge is created on fluctuating assets. Think of your daily raw materials, your stock in trade, or your debtors. You are perfectly permitted to use them for your day-to-day trading. So to remember this, a fixed charge is tied down heavily like a massive factory machine, whereas a floating charge flows dynamically, just like your ever-changing daily stock.
But what happens when things go wrong? Well, that floating charge crystallizes, and that just means it becomes a fixed charge. Students constantly confuse crystallization, so let's create a visual association right now to lock this in. Imagine the floating charge is flowing water. Crystallization is the exact, precise moment that water freezes into solid ice because the company did something wrong. And this freezing happens in 4 specific events: when the terms and conditions of the loan are violated, when the company just ceases to continue its business, when the company goes into liquidation, or when the creditor actively steps in to enforce the security. Mark this down as a solid 2-star exam concept.
Moving right along to Section 2, registration and modifications.
Guys, this right here is incredibly important for your exams. You have to memorize this Section 77 timeline for charges created on or after the 2nd of November 2018. The primary duty is on the company to register the charge within 30 days of its creation, paying just the normal fees. If you miss that, okay, you get another 30 days, meaning up to 60 days total from creation, but you're going to pay an additional fee. If you are still dragging your feet and you're late, the ROC gives you up to 120 days from creation, but now you'll be hit with an ad valorem fee, which is a hefty fee based on the actual value of the charge. Remember this specific rhythm. It's a 30-30-60-day jump. Day 30 normal, day 60 additional, day 120 ad valorem. 3 huge stars for this one, folks.
So, how do we actually file this? First, I want you to remember this quick memory trick for the forms. 9 is for notes and debentures, 1 is for everything else. Simple, right? Form CHG-9 is strictly for debentures, and CHG-1 is for all other loans. Now for the verification of the instrument. If the property is wholly outside India, it can be signed under the company's seal or by a director, CS, authorized officer, or even a person interested in the charge. But if the property is in India, you completely drop that interested person option. It absolutely must be the director, CS, or authorized officer. And hey, here's a golden exception the examiner loves to hide in an MCQ. Any charge created by a banking company in favor of the RBI does not need to be registered with the ROC at all.
And this perfectly illustrates a top mistake students make year after year. What are the actual consequences of non-registration? Well, if you don't register, the liquidator and other creditors will just completely ignore your charge. You lose your priority line. But, and this is a massive 3-star trap right here, the debt itself does not magically disappear. Only the security is lost. The company is still legally liable to repay the money as an unsecured loan. Do not ever let the examiner trick you into thinking the loan is completely canceled just because it wasn't registered.
Now, what if the company is just lazy and skips that initial 30-day window altogether? Well, Section 78 steps in to save the day for the bank or the charge holder. The charge holder can actually bypass the company and directly apply to the ROC. But the ROC won't just register it blindly. They're going to give a 14 days notice to the company, basically asking, hey, why shouldn't we register this? If the company shows no sufficient cause, the ROC goes ahead and registers it. And honestly, the best part for the charge holder, they are legally entitled to recover all the registration fees they just paid directly back from that defaulting company.
A really crucial point here is Section 79, modifications. The exact same registration rules we just talked about apply if you modify a charge. But what actually counts as a modification? Well, enhancing the loan limits, changing the repayment schedule, a partial release of an asset, seating a pari passu charge, and, listen very closely to this one, even changing the rate of interest. Yes, changing the interest rate triggers a modification filing, unless it's just a standard bank rate change for fluctuating loans. Now, once any of this is registered, Section 80 kicks in. This is called deemed notice. From the exact date of ROC registration, the whole world is legally presumed to know about this charge. If someone buys that property later, they absolutely cannot cry in court, but I didn't know.
All right, let's shift gears to Section 3, satisfaction and registers. When the company finally pays off the loan in full, we trigger Section 82, satisfaction of charge. Here is your memory trick for this one. 4 is for closure. The company has to file Form CHG4 with the ROC within 30 days of making that final payment. Now, the ROC can extend this up to 300 days with additional fees if you're late. Once filed, if that form isn't already signed by the charge holder, the ROC sends a 14-day notice to the bank just to verify, like, hey, did they really pay you back? If the bank doesn't object, the ROC officially records the satisfaction and issues Form CHG5. CHG5 is basically your official freedom certificate proving the asset is completely clear and yours again.
Please mark this comparison down for your last day revision. It's vital. Section 81 is the register kept by the ROC online on the MCA portal. But Section 85 is the register kept by the company itself. The company has to maintain this in Form CHG7 at its registered office, and it must be authenticated by a director, CS, or authorized person. Now, I want you to focus really hard on the preservation rule. This is a classic 3-star exam trap. The register of charges itself must be preserved permanently. However, the physical paper instrument creating or modifying the charge, that only needs to be kept for 8 years from the date of satisfaction. Please, whatever you do, don't mix those two timelines.
Just briefly, under Section 84, if things turn really sour and someone gets an order to appoint a receiver or manager to take over the charged property, the ROC and the company absolutely need to know about it. Form CHG6 acts as this loud megaphone announcing the appointment. You have exactly 30 days from the order or appointment to file CHG6, and keep in mind, the exact same rule applies when they eventually cease to hold that appointment.
Moving on to Section 4, defaults, penalties, and rectification.
Section 86 lays down the punishment for contravening anything in this chapter, and it is a straight flat hit. No ranges, just a flat fine. The company gets fined 5 lakh rupees, and every single officer in default gets fined 50,000 rupees. But beware, if anyone willfully furnishes false or incorrect information or deliberately suppresses material facts, they are inviting the wrath of Section 447. And in corporate law, you should know by now that Section 447 fraud provisions will completely destroy you with the massive fines and potential imprisonment.
But hey, what if you didn't commit fraud? What if it was truly just an honest mistake? Well, Section 87 is your lifesaver here. The central government has the power to rectify the register. If you somehow omitted to intimate the ROC about a payment or satisfaction, or if there was just an accidental misstatement in your filings, you can apply directly to the CG. The central government just needs to be satisfied that the omission was truly accidental due to inadvertence or had some sufficient cause, and most importantly, that fixing it won't prejudice the creditors or shareholders. If they're satisfied with your reason, they'll grant an extension or permit the rectification.
And finally, Section 5, our mega exam revision. Take a mental picture of this form mapping immediately. This is your absolute holy grail for MCQ accuracy. It maps out every single form from CHG1 all the way to CHG9. Let's run through it quickly. CHG1 is your base registration. CHG2 and 3 are the ROC certificates for registration and modification. CHG4 is your closure for satisfaction, which then leads to CHG5, the ROC certificate of satisfaction.
CHG6 is that megaphone for a receiver appointment. CHG7 is the company's own permanent register. And finally, skipping 8, CHG9 is exclusively for debentures. Memorize this list and I promise you will easily secure those quick MCQ marks.
Let's lock in the top exam pitfalls you must avoid on exam day. Number 1. Thinking non-registration cancels the actual debt. It doesn't. The debt survives, only the security dies. Number 2. Do not mix up the 30 normal, 30 additional, and 60 ad valorem days under the Section 77 timeline. Number 3. Remember that tweaking an interest rate triggers a Section 79 modification. And finally, under Section 85, you keep the register permanently, but the physical instrument itself is tossed after 8 years from satisfaction. Be extremely careful with these. They are specifically designed by the examiner to trick you. I am going to leave you with that provocative thought to really test your AR-level conceptual clarity. If it wasn't registered within those maximum 120 days, remember the legal consequences we talked about. The liquidator and the creditors will completely ignore it, regardless of whether it crystallized or not. Your priority is totally gone. I want you to review your notes, keep this logical flow in your head, and you're going to absolutely crush those exams. Thank you so much for joining this explainer and happy studying.